What up, world? So, as promised, I'm going to put out this vlog on Twitter. I'll also post it on YouTube about direct investments into OTCs. The last video I made, I guess I spiked some interest. I look back at it and I understand why, because I kind of nonchalantly stated that you can make direct investments into OTCs instead of buying them on the open market. And people, I think, wanted to know how. So, I have an outline over here. So, if you see me looking over here, that's what I'm looking at. I'm going to go over a few things and define them first, and then kind of give you my breakdown as to, terms, how I would do it, and what you shouldn't do. So just some things we're going to go over: contracts and clauses, private placement, warrants, options, debentures, loans, bonds, asset-backed securities, negotiations and ratchet agreements, preferred stock, the difference between loan and equity, and more. I'm going to try to make it as concise as I can. So a little bit about me: went to business school, went to law school, interned at Miro, New York Stock Exchange, then worked at an investor relations firm on Wall Street, helping companies under 500 million. And I currently work at an OTC company. But let's get into it, right? So I got a few things here that I kind of want to touch. The first thing, contracts and clauses, and I kind of put part of this outline on my Twitter too. So contracts and clauses. In America, we have the freedom to contract, which means any individual, two individuals, one corporation and an individual, or two corporations generally have the freedom to contract how they want. And this becomes important because you're going to deal with a lot of regulations and questions about, can I do this? So let's start with that basis, that individuals and organizations have the freedom to contract in America how they feel free to contract with each other. And in those contracts, there's clauses. And this is important because most of the detail are in the clauses. So it doesn't matter as much as what the contract says, as much as what the clauses inside of them say. Because it can say partnership agreement, it can say private placement for stock, but that doesn't really tell you anything until you read into the clauses. So understand that we have freedom to contract, and the clauses are where you're going to look for everything, whether it's in a filing, whether it's in a contract, etc. Private placement, and these are words that you want to know. I can't give you guys everything here in the 7 minutes, but these are things that you kind of want to look into and dig deeper into, right? Private placement. Private placement is, and I'm going to, so I don't do it. A private placement is a sale of stock, shares, or bonds to pre-selected investors or institutions. This usually comes in the form of a private placement memorandum. So it's a document that is exchanging, right, the sale of the securities that you're offering. The securities could be stocks, it could be options, it could be warrants, it could be bonds, right? Those are all securities. They're securitized by something. So if you look at a stock is a security because it is secured by the company, right? You actually own a piece of that company. So you don't own a stock. That stock is a percentage of that company. It's securitized in that manner, the same way a dollar bill says, backed by the U.S. government, securitized by the government. A mortgage is securitized by real estate. So these are securities in general, right? So private placement is generally the document that exchanges that. And again, I'm going to define these, and I'm going to go into how exactly I would make an investment into a OTC company, and hopefully how you guys may be able to learn how to make one too. Stock warrants. A stock warrant is a contractual agreement between an issuer and an investor. It gives the investor a right to buy a certain number of shares at a set price. Now, I want to make a disclaimer here, and I'm going to make this disclaimer on a lot of these terms. While a warrant is generally that, right? Most people don't know what a warrant is, including sometimes the attorney, including sometimes the CEO. So a lot of times you'll see a warrant agreement, but you have to read the warrant agreement, because that warrant agreement, while a warrant, and I'll give you the definition again, right? It basically gives the investor the right to buy a certain number of shares of the stock at a set price. So let's say the stock is trading at $1 and you have a warrant for 10 cents. That means you have the right to buy one stock at 10 cents, even though it's trading at $1. And why would they want to do that? Why would anyone want to sell you the right to sell it? Because they're getting the money, right? They're getting the money, and they're actually not selling you stock. They're selling you the right to buy stock. So it doesn't dilute them right now, right? Until they exercise that option. So that's a warrant. But if you read a warrant agreement, sometimes warrants don't read anything like that, right? Sometimes it warrants the right to do something, the right to issue more shares. So it's very important that you read through whatever these things are, because just because the financial definition is like that and the legal definition is like that, it doesn't mean in practice that they actually use that word that way. So make sure you're reading it. But that's generally what a warrant is. Stock options, I think a lot of you guys know this. It's a contract between the parties to sell the right. It's almost the same thing as a warrant, right? It gives the buyer the right to sell the underlying stock at a predetermined price. So I can buy the option from a company to buy stock at $1. The stock is trading at $1. It goes up to $1.20. I now made 20 cents on the option, right? In option trading, on retail trading, it's usually a contract of 100 stocks. So when you buy the option, you buy the right for 100 shares. When you're doing a private placement or a deal between an OTC company, that number changes in that document. Back to that contract, it can be written however you want, however you guys agree on. So it could be for 50 shares, it could be for 100 shares, it could be for a million shares, right? That's negotiated. So those are options. Debentures, an unsecured loan certificate issued by a company backed by the general credit rather than by specific assets. So again, a debenture is basically like a loan, an unsecuritized loan. So saying, look, if you guys can't pay, then belly up goes the company. I'm going to have to sue you to get my money back. But it's not backed specifically by a building or real estate or stock, right? Which sometimes they are. Now, again, disclaimer, people don't know these definitions like that. And sometimes they may put in a debenture that's backed by an asset, and all of a sudden it is collateralized, right? But they called it a debenture. So these words get made up in finance all the time. You know, a collateralized debenture, CDOs, collateralized debt obligations. These are words that compounded words that they took one word, they add another, and all of a sudden they created a new financial instrument. So be careful when you're reading these documents to understand that. But a debenture generally unsecured loan by the business credit, so it's not secured. Okay. Next one, bond. A bond is very similar. It's a loan, right? But usually it has set terms. So, you know, 5-year bond at 10% interest on $100, that the person who issued the bond is paying 10%, $10 a year until the end of the 5 years. And then at the end of the 5 years, they owe the $100 back. That's a bond. So if a company wants to raise money, they can issue, you know, $10,000 bonds at 10% interest. And now you as an investor, you come to the company, you give them $10,000. The company now has $10,000. They owe you that 10,000 back at the end of the term. If it's a 3-year, 5-year, 7-year, right? At the end of it, you're going to get that 10,000 back. And along the way, you're going to have progress payments of interest. And when do those payments come in? Depends on how the bond was written. If the bond was written quarterly, yearly, it can come in that way. Okay. So asset-backed security, just another term. This is something where, you know, you can issue stock and say, look, this stock is backed by this piece of real estate. Or you can issue debt and say, look, this bond is backed by this piece of real estate, backed by this machinery, backed by, you know, this stock portfolio. They have another stock portfolio, another securities portfolio. So again, these are words you want to look up. Ratchet agreement. This is an anti-dilution provision or mechanism that basically predefines a conversion ratio at a certain price or at a mathematical formula. These get really complicated. I don't want to get too heady here, but basically this is where you see a lot of what they call death spiral financing or downward pressure financing. In some cases, what people call toxic financing, which I think that term is overused. People don't really understand what that is. But basically what it says is, look, if the stock is at this price, we're going to convert at this price. Or, you know, when we're about to convert, the mathematical formula is, you know, the current trading price or the average of the current trading price multiplied by this number, right? That's a ratchet agreement or a full ratchet agreement. And then preferred stock. Preferred stock is just like regular stock, but it gives you a special option. Generally, historically speaking, preferred stock was the ability to, you know, get a dividend first before everybody else got a dividend. But preferred stocks are one of these contractual exchanges that they put a lot of terms in there. So preferred stock could be like, you know, you get it, but, you know, you have to pay out a certain amount of revenue. A preferred stock can have a special conversion. So it's like, look, we're going to give you this 30 million, but it also gives you a warrant attached, or it converts at this price, right? If we go public or if they're registered. So preferred stock is just regular stock with a special clause in the agreement, in the transfer of that stock, that says, you know, you're either entitled to stock dividends first, or you're entitled to a certain amount of equity or a certain amount of revenue split. What you can put in there is limitless. Again, we have the freedom to contract. So preferred stock is definitely a different type of equity ownership that it claims income from the company operations. Is basically what it does. Okay, so now quickly before we get too heady and too long, we're already long here. Terms. How would I go about the terms? So first, loans versus equity. Loans. The reason loans are so powerful is because the first person that has right to claim on the assets of a company is the debtors, right? So that's anyone who gave you a loan. After that, you can pay out equity, aka the owners, aka the stockholders. So if I have a loan on a company of $10,000 and somebody else owns 10,000 in preferred stock, if that company's about to go bankrupt, the first person that have to pay is the people they owe. The second people are the equity, right? So that's why debt is so important, because sometimes debt forces the hand. If I don't have any conversion provisions on that debt, I'm going to be able to, you know, force bankruptcy basically on the company. So it's a very strong position. The debtors always get paid first before equity. So that's why you see when a lot of CEOs, I don't think rightfully so, but they put a lot of debt on the books to keep control of that company. They also put debt on the books because once it's aged, and now I'm getting real heady, once that debt is aged enough, they can sell that debt in exchange for free trading shares to someone else. So if someone else buys that debt from the company, they can convert that at a predetermined number with in agreements with management, or if it's a contractual because it was already in the bylaws or it was agreed upon before, they can convert that and trade today. Most of the time, when you're issuing private stock, there's a restriction on it, and you can't trade out of it right away. 6 months to a year generally. So let me get to how I would do it, because we're already at 11 minutes. How I would do it, I would call an OTC company, and first I would ask them, hey, would you take, a loan, or would you take, private placement of my stock? And then I'd come out with a term that I feel like is a good term. A lot of times they have set terms, but $1,000, $5,000. Usually you're going to go on the terms with the company, right? The company's going to give you terms. If you're talking about 100,000, $1 million, now you have a little more negotiating power. So how I would do it is I would just call them, right? And I would say, look, I want to directly into the company. Do you have good terms? And you're going to see that some people do have good terms, and call enough people, and some people won't have good terms. A lot of times they might sell you a private placement with a warrant attached. So they may say, look, the stock is trading at 10 cents. We'll sell it to you at 8 cents. And that's the deal, because you're giving them $1,000, right? Or $5,000. You're giving them, $10,000. They may say, okay, we'll give it to you at 8 cents, and we'll give you a warrant for each share you buy at 5 cents. Okay, so the right to buy that share at 5 cents, which means you have to go back to the company and give them another 5 cents per share for every stock you want to hold. Now, if the stock keeps going up, that becomes more valuable. If the stock goes down, it doesn't become valuable. It's also a tax advantage, because you're not getting the equity, so it's not showing up on your books. It's an option contract. So I'm not an accountant, but I've seen a lot of investors only play with options directly into OTC companies, because they don't want the tax liability. Because if they buy the shares and the shares go up, now they have a gain, right? That they might be able to get taxed for. So that's how I would do it. What I wouldn't do, so I have one more note here. What I wouldn't do, what I wouldn't do is nag these CEOs, right, for a $1,000, $2,000, $3,000 investment, and try to negotiate, on 4, 5, 10 phone calls to get $1,000, $10,000 in. They're busy building companies, at least they should be, and they don't have time to go back and forth like that. So just keep that in mind. But the first step is call them and ask them and say, look, do you have terms? I got 1,000, 5,000 I want directly into the company. And what are those terms? And they can send you something, or they say, you tell me what you're thinking. And if they say, you tell me what you're thinking, your job is to financially structure a direct investment that secures you, right? The word hedge funds have become very successful, and the term's kind of been thrown around. But the word hedge is to buy insurance on something. And what it does is it eliminates risk. So, for example, if I put a $100 bet down on something, but I have an insurance that pays me $30 if I lose, I can't really lose all my money, because even if I lose this investment, I have $30. So that's a hedged bet, right? And when you're making direct investments into an OTC, that's what I would be thinking about doing. I would be thinking about, how do I make a hedged bet? So if the stock is trading at 10 cents, I know there's a chance that it can go up. I also know a chance it can go to zero, right? So what's my hedged bet? Number one, risk capital management, right? Capital management. So I'm making sure I'm not betting my last dollar, right? Because there is a chance it can go down. And then what other perks can I have? Can I have them secure that on assets of the company, right? Can I have them issue me warrants to give me, a better outlook or better return on my money if the stock does go up? Is it a loan? So I don't have to risk it. I can just say, no, you owe me that money, right? So give it back. Now, if they can't give it back, a lot of times what happens is they convert it. They convert it into shares. Now, this is why the debtor is in such a strong position, because if they didn't predetermine a price for that conversion, now it's up to negotiation, right? And who do you think has the leverage there? Well, the person that you owe money to has the leverage there, right? Because they're like, hey, no, you owe me the money. I don't want your stock. You say, wait, you're going to drive us out of business, right? Because they can force bankruptcy now, because you can't pay that, or they can They have leverage. They have leverage there. So that's how I would do it. I would go and I would try to negotiate the terms. Um, yeah, and so I mean, I hope this is helpful. I know I threw a lot at you guys. There's a lot to digest there. But step one, call the OTC company and see if that's something that they're willing to do, right? And then, ask them if they have set terms and what they're thinking about. And then you have set terms in your mind. How would you play it, right? Do I want to issue a loan? Do I want to issue a bond? Do I want interest payments every 6 months? Do I want interest payments every year if it's a bond, right? Do I want to have just options? So options are a real cheap way, right? It's like, hey, I want the option to buy 1 million shares at, if you buy them out of the money, they're going to give them to you super cheap, right? If you buy them in the money, they still might give you a hell of a deal because you're not diluting when you're buying options. And then, as far as regulation, because there's going to be a lot of questions, can I do this? Is this legal? First, contact an attorney, or have their, at least the corporate attorney, run it by, or rely on another attorney. But then, all bodies of securities laws have been codified at this point, generally under the what do you call it, the code, right, the USC code. But they all derive from the 1933 Act and the 1934 Exchange Act. So the 1933 Securities Act basically, made disclosure, regulatory requirement for disclosure. Before that, it was blue sky laws. They were individual. Every state had their own laws, and we had to comply with blue sky. So we had to comply with 50 different set of laws. And in 1934, they put it all under the 1934 Securities Act. And then the next year, the 1934 Securities Exchange Act, which kind of added more regulation to that act. But most of the answers to your questions are in that act. So if you want to find, am I doing this right? Am I legally doing this? Most of the laws would be there. So I hope this was helpful. If there's any other questions, put them in the comments section below. And if there's any, I'm going to make the videos for the other subjects, as concisely as I can. I know this one went long, and I'll put it on my YouTube if it doesn't go all the way. But thanks a lot for listening, and let me know what you guys think. Peace out, man. I'm rooting for you guys.